Happy New Year from ADK Wealth Advisory Group. Starting off with a very wet St. Louis and cold. I want to thank all of you for some of your notes through Facebook as well as the emails just asking if we were okay with the floods that came in at the end of last year. That affected the southwest part of the city where our office is located, probably 20 minutes from there, and my home's about a half hour, so relatively speaking we were unscathed. Personally, we did have a non-flood issue. If you take a look at where I live, there's a big creek in the back, and the just vast amount of rain that created so much water caused our creek bed to collapse and took some of our fence. So we'll show you some pictures of that. But if you think about collapsing, that's really the theme of what happened in 2015. And our purpose today really is to look back to 2015 and then look forward, say short term, the next 6 months, and then long term, the next 3 to 5 years. So let's take a look at 2015. Year started off really solid, not great, but not bad. And then you had what I would call is thematically, you had a central bank policy that influenced hedge fund behavior. And so let's walk through an exact example of that. So the United States Federal Reserve has no new news relative to the fact that they were going to be raising rates. But that sort of sprung up as a main topic for the media. And then you saw all kinds of problems in China with a lot of overbuilt real estate and bad debt associated with that. Again, no new news there. But then what really became very big news is this thing called a carry trade, which many of you have read about, heard about, but very few know what it really means. So a carry trade is when a big money institution borrows money in one region, let's just say St. Louis or New York. And in essence, they borrow that money at a low rate. They borrow it in America, so they do it in dollars. They invest that money in Asia, let's just say China, and so then they convert it to the renminbi. At some particular point, they're going to close that trade because their primary motive is to make more here than what they're paying there. So as they sort of anticipate the Fed raising rates, which is a headwind to their profit, then typically when a central bank raises rates, that causes the currency to go up, the dollar in this case. So in anticipation of that, a carry trade means that they'll sell their position out there and bring it back to the country that they borrowed, paid off the debt. So in essence what that does is it creates a lot of sell pressure, in this case in China, and then it also creates a lot of repurchasing of the dollar, so it props the dollar up, both of which we saw in very strong fashion. You could almost call it a W recovery. So late summer, the market spent about a year plummeting in value, and then it stopped, started to recover, started to go back down, everyone's wondering which way is it going, and then recovers back up. Total period takes probably on average about 3 or 4 months from peak to peak. So if you were to translate that into 2016, the first 6 months, we believe that what we're going through right now is very similar to that. It's issues around China, global trade, issues around concerns with what will happen with the global economies. But more than all that, it's hedge fund money closing out carry trades, creating an enormous amount of volatility. We believe that continues for the first 6 months. We don't believe that this is a crisis. And the reason that we don't believe that this is a crisis like say a 2000 or a 2008 is some of the central themes that don't exist now that did there. The main one is overvaluation of a lot of assets. The other is recessions throughout many different parts of the world. And so those two things really do not seem as though they're current. So valuations in the Chinese stock market are overvalued, but everything else seems reasonably priced, trading at a slight premium. There's very little things that aren't energy oriented that are trading at a deep discount. So valuations aren't a problem. The second thing is that we have slowed growth, but we don't have recessions. And so say, for example, within the United States, we see jobs being added. They're not great jobs, but they're being added. We see consumers spending more money as a result of the lower energy prices. So our belief is that this will be either a V-shaped recovery. We don't believe that we've seen the bottom of it, but that's big guesswork. We believe that you'll see another W. Investing always involves risk, so you really never know is that the next collapse or not. Our research says it's probably not, but we're committed to making sure that we do the best risk management for you. That being said, I think that there's a metaphor right now around fundamental and technical research. When you think about a pilot and a co-pilot, we spent a lot of time in our last market update talking about fundamental research and technical research. So I won't go back into that, but if you need a refresher, simply go and rewatch. But the metaphor is that the fundamental research is like the pilot of a plane, and the technical research is like the co-pilot. So they're traveling along. We believe that we're in an environment where for the assets that are volatile, so you have two types, non-volatile and volatile, oversimplifies it, but to make the point, we believe that that volatile money, that there should be a switch where instead of the fundamental pilot being the main emphasis, that we should switch and have the technical be the main emphasis. So in your upcoming annual review, we'll go into the details around what that looks like and more of the why behind it. If you have any questions when you watch us, shoot me an email or a call. So if I were going to summarize everything, I would say 2015 started off good, ended bad. 2016 has started off the worst ever. It's a continuation of what was going on. We believe that that's around for the foreseeable future, probably the first 6 months of the year. We believe the next 3 to 5 years have a very similar characteristic to what you see at the end of a market cycle, which is a lot of choppiness, has the ability to provide reasonable returns, but it's not going to feel very good. Thus the point of at your annual review wanting to cover some strategic changes that we're recommending. The other point I would like to emphasize is many of you have connected with us on Facebook through ADK Wealth Advisory Group and LinkedIn, which is my own personal one. If you haven't done that, I go in probably twice a month and put things that I think are pretty relevant that many of you would like. So please connect with us that way. I promise I'll never tell you what I'm eating or any of that type of stuff. So I'd like to close by saying thank you very much for your trust, and thank you for caring about us enough to reach out during the time of what I would classify as really a difficult time for the city. Thank you. Have a great day.